All right, let's break it down. Welcome, everybody, to this segment today on what I like to call family banking. And family banking is a 200-year-old strategy. It's been used by the wealthiest families, banks, corporations, businesses, really big empires that America was built on. This strategy was used by those people to build their generational wealth. And with this concept, it's not going to add any more risk. It's not going to take any more of your time. It's not gonna affect what you're really doing right now, but it's gonna 10x your financial life. And what I mean by that is it's all gonna start with one thing. By you changing one thing in your financial life, and that is where your money goes first. By the change of just that, everything in your financial life will change. And the reason this segment on family banking is a part of this community and this program is because it's important. It's because it's a concept that is going to build your foundation to build wealth. There's no other reason people would want this concept in this sector, in this program, without it being valuable. It has changed my life. It has changed Brandon and other people in this community's lives as well. And I hope it can change yours. So I urge you guys to listen and take a lot of notes during the next 20, 30 minutes because I hope to change your life. And I want to start with a little bit of imagination. Those of you listening right now, I want you guys to imagine, just real quick, close your eyes, think about it. What if you owned a restaurant? Imagine where would that restaurant be? What kind of food would you serve? If you owned a restaurant, what would that look like? Right? You all probably have an image in your head. Maybe you are a restaurant owner. Now imagine, would you guys go out to eat with your family, with your friends at your restaurant? Of course you would, right? You wouldn't go to the next door down the street. You wouldn't go to your competitors. You'd bring everybody to your place. Well, what if you owned a salon or a barber shop? Would you guys go get your haircut at your salon, your barber shop? Of course you would. You wouldn't go to anybody else. Doesn't make sense. What if you owned a gym? If you owned a gym, would you guys work out every day at your gym or would you go to Planet Fitness or 24-hour fitness? No, you'd always go to your gym, right? You never see the gym owner not at their gym working out. They're always there. And last question. If you owned a bank, would you guys make deposits in your bank or somebody else's? Bank of America, Chase, Wells Fargo, your bank, right? If you needed a loan for a car, a house, or you're doing rehab on some rental properties, would you guys get that money from your bank or somebody else's, right? That you'd use your bank. And if you borrowed money from your bank, would you pay your bank back with principal and interest? Of course you would. Absolutely. You would never steal from your bank. Just like you wouldn't steal from your gym or your salon or your restaurant. You don't steal from your business. So why don't all of you listening today have your own bank? It's because you haven't learned how to yet. And that's what we're going to talk about today, is how you can become your own bank, as it says right up here. Okay? Again, this concept has been used for over 200 years. And it wasn't invented by me, obviously. But you know who used this concept? I keep mentioning this is old and families have used it. Here's some real people behind that. Mr. Good old the Rothschilds. The Rothschilds used this concept. The Rockefellers, Mr. John Rockefeller, he used this concept. What about, you guys know this guy, Ray Kroc? What did he start? McDonald's. And what business is McDonald's in? They're not in the business of selling burgers, I'll tell you that. They're in the real estate business. But how did they start that business? Using this strategy. What about Mr. Walt Disney? You guys know him? I'm sure you all do. Been in Disneyland, Disney World, Disney Plus, you probably have. How did he start his business during the Great Depression when he was absolutely broke? Okay. This is how. He used this strategy to build that business. And what about in today's modern era? You guys know Mr. Jim Harbaugh? He is the head coach of the Los Angeles Chargers today, but he was the head coach of the College Michigan. And when he got his contract I think it was 2016, he incorporated this strategy into his contract, despite what everybody else told him. He knew this was the way to build himself and his family generational wealth. And I'm going to show you guys today how all of them became their own bank, just like you guys can. And so you guys have a little bit of confidence in me and your speaker today in this little segment. I want you guys to just know who I am real briefly. This is myself and my wife, Carson and Anna Herline. We live in Southern California. We love to be outdoors. We surf, we travel the world, we do all kinds of fun stuff. We love sports. But over the past few years, I've actually met with over 3,000 families across the country, teaching them this wealth building strategy. And this has allowed Anna and I to do some pretty freaking cool stuff. We've traveled the world, we've bought millions of dollars in real estate, and it's really given us just the perfect foundation to build generational wealth for our family that we're starting. And my story is pretty simple. I actually bet most of you can relate to it. In my early years, I made a lot of mistakes, as young people do. But I did do one thing right. At 18 years old, I actually went and served a church mission trip for a year and I lived abroad. Amazing experience. But when I came home, had a lot of outside influences pushing me different directions. In one hand, I held a traditional route, the traditional mindset. I was going to be in a finance degree. I was going to go in corporate America. I was going down this path. And in this other hand, well, I was around entrepreneurs and business owners, real estate investors, and I saw the freedom and control they had in their life. I wanted that. But this seemed so tempting and like the right path also. And so I kind of was pushing back and forth for a while. There was tension building between these two parts of me. And I had to make a decision. And that decision was to drop out of school and actually pursue an education in investing, to learn how to make money work for me and get out of the rat race. And that's brought me extreme happiness and success thus far. And I am early in my journey, guys. And so I'd love to just share with you guys what I've been so fortunate to learn already. And I want to start with money because with money, we all have different realizations about it. We all have different perspectives of it. And really, it's an ever increasing journey of financial education throughout our lives. And so I want to pose this question to you, and I want you to stop and really think about it. Could it be possible that there are more efficient environments to store wealth outside of commercial banks that we are not aware of? Okay. Really think about that. That should be a yes for most of us. I'm sure we all realize there's probably better things to do with our money than give it to the banks. But are we doing that? Probably not. Now, this question's powerful because it's really about what you're not already thinking about. It's what you haven't been taught to think about. And I hope when it comes to money and throughout this presentation, we can have a humble and learner mentality so we can really dive deeper into this and be open to these new ideas. And it all comes down to what every rich person talks about. You read anyone's book. You read Rich Dad Poor Dad, for example. Robert Kiyosaki. I'm sure most of you read that. One of the main rules or laws he uses to build wealth is save money. Save 10% of your income. 1/10 goes to you. Super simple. If you can't save 10%, you're not going anywhere. Most of America right now actually saves, I think, between 2 and 5% of the current number. So it's horrible. And I think the problem is in our American culture, we don't value savings. We don't value the retention of our dollars and our control. And I think the reason that is, and I'm convinced of it, it's because Americans, we're not saving enough money because the environments or the places we've been told to store money are horrible. They're incredibly inefficient. They don't do anything. They don't seem to move like your high yield savings accounts, like your 401ks, like your CDs, your savings vehicles. They're so inefficient. And it's forced us as Americans to just stop saving. And so what I'm going to talk about today is actually banking. And when it comes to banking, it really is a major paradigm shift for most people when they start learning about it. And the interesting thing about banking is that it affects everything, every single component of your life. So wouldn't it be smart to just learn a little bit about the banking function or banking needs in your financial life and how that actually applies to you? And so throughout this presentation, again, have an open mind because once you see the banking world and how it actually can complement your life, not take over, not exchange, but complement what you're already doing, you'll never be able to look at money the same way again. And so I said that I was going to teach you guys today how to set up your own bank, right? Well, what if the bank that you were setting up was going to replace the current account that you're storing your money at right now, the traditional banks? Anytime you ever needed to buy something, invest in something, that money came from and to your bank. So let's start with some of the attributes of what you'd want your bank to be. If you had a ultimate place to store money, what would you want that place to be? And I'm going to compare it to a traditional bank where most of us save money. And most of us save money in traditional banks because it's liquid. That's the only attribute of why we store money there. It's liquid, it's usable, we can take it when we want. But what if I told you your bank was also that? Perfect. Now they're equivalent. But most savings accounts right now in America, the average actually currently, they're making 0.07%. Very, very minimal amount. What if I told you your bank made 2 to 6% guaranteed, no matter what happens, uninterrupted, always, and compounding? And what if I was to tell you that was tax free? That'd be a pretty freaking cool place to store money if that was tax free, right? Your bank, when you get your 2 cents of interest, it's taxed. As you all know, it's stupid, right? What if I told you it was also protected? You were ever in a lawsuit, judgment, lien, your money sitting here is protected and safe. Okay. As we saw during COVID and many times in history, banks collapse. They are not stable. They are completely leveraged to the brim. They fail and go bankrupt all the time. What if I told you your bank never did? It was completely stable, completely protected, and tax free. Man, that's a good place to store money, wouldn't you think? How could a place like this even exist in America? I've never been told this. What is this? Well, this is a place you actually can control. If you stored your money here, you're in complete control. You can count on it. You can use it as the foundation to finance everything throughout your life. And I get it too, because like we're all busy. We all got lives, we got families, we got businesses, we got real estate we're trying to get into. So the opportunity to actually put money somewhere that's still liquid, but it's also compounding, guaranteed, tax-free, risk-free. And what if I was to also add to this that if you did take money out of your bank, it wasn't going to stop the dollars from compounding? Oh, now that's something that every person should dive deeper into. Wouldn't you agree that this is a much more efficient place to store money outside of the commercial banks? Like I mentioned in my question that we're not aware of. This is a place we're not aware of. This is your bank. So let's get into what this bank is. What can we actually do if this was our bank? So to make this strategy work, we're going to need the bank, right? I mentioned it multiple times and I'll keep mentioning it. I like to treat this bank like a machine. Okay. I'm not going to treat this bank like an investment, just a machine. Your money's going to flow through the machine for you to then go use it. So what is the machine we're going to use? And that's really, you guys are already using a machine. You're already using somebody else's bank. That's called Wall Street, called that world. It's where you're keeping your money. And so I often like to start with this quote before I mention what the machine is. Will Rogers said, "The problem in America isn't so much what people don't know, it's what people think they know. That just ain't so." Guys, great quote. I think this probably applies to a lot of things in America today. But when it comes to money, don't judge what I'm about to show you because you don't understand it yet. This machine that we use that has all those attributes I just mentioned is none other than a dividend paying whole life insurance policy from a mutual company. Now, I'm not there in front of you, so I can't make sure you guys keep watching. But this is the part when people think, "Oh, they're just going to sell me insurance." Well, not at all. This is not regular whole life insurance at all. This is not the life insurance your broke brother-in-law will sell you or your insurance store down the street will sell you. No, 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 no. This is very specially designed and engineered whole life. And a lot of people have questions because they hear Dave Ramsey and Susie Orman say that this is a terrible place to keep money. Well, I'll agree with them. If you put your money in a regular old whole life with the expectations of it doing what I'm about to show you, you're going to be really upset. This is specially designed and engineered whole life, just like the Ford Focus in the dealership. What I mean by that is when you guys go to the local Ford dealership and you see this dope Ford Focus in there, right? You think that's the car I'm going to get. Well, whatever, it's a fine car, right? Well, when you go home, you're on YouTube, you look up Ken Block. You go on YouTube and you see Ken Block drifting 140 miles an hour around a turn with this car. Yes, it's a Ford Focus, but that looks way different than the one in the dealership. The difference between these two Ford Focuses is the design and engineering. So the specially designed whole life that we design looks nothing like life insurance. It actually looks more like a supercharged bank account, I like to call it. And as you know, many of you are probably still not believing this, but remember a few minutes ago when you said you would agree that if there was a place to put your money that had all of those benefits, you would. Well, that's what this whole life policy can do if structured correctly. You just haven't learned how these policies actually work, and you've been sold or told the wrong thing about it. And often there's the main misconceptions. People say whole life insurance has a low rate of return. It's expensive. It's the worst investment of all time, I've even heard. If you're watching this, please write this down. And if you're not going to remember anything I tell you today, remember this. Whole life insurance is not an investment. Not at all. It has nothing to do with investing. This is a guaranteed contract that is all about control and banking. So if you could take anything today, take that. Now, when you guys go home and you start talking to your neighbor, your friends, your business partner, and you bring up this concept, they're going to tell you whole life's a scam, right? It's probably what they're going to tell you if you tell them that you're going to do this. And as soon as you hear that, as soon as you hear someone call whole life an investment, you know that person actually has no idea what they're talking about because they can't even correctly identify what type of asset it is. It's not an investment at all. And so you're not going to get a policy built for banking like we teach from just a regular insurance agent or financial advisor. You can't. You have to get it from a banking professional who studies this and knows this specifically. And so what I want to talk about today is again, how we can be the bank, how we can copy what banks do. Well, they use whole life insurance. Believe it or not. Look this up. BOLI, BOLI, bank owned life insurance. Guess what? You'll find that banks own more whole life insurance. Whole life, not IULs, not VULs, not term insurance, whole life. And they own more whole life than they own in land and buildings combined. Banks are actually the number one purchasers of whole life insurance in the world. Not only do they own more whole life, they buy more and more every single year. So are banks stupid? Or do they know something that I don't know? We don't know. We're not taught. Well, guys, between these four banks, you all know there's $60 billion of whole life. So, guys, they're not stupid. They're smarter than I am, smarter than you are. We just need to mimic them. And this whole concept started from a guy named Nelson Nash. He wrote this book called Becoming Your Own Banker. And he said the problem in life is that you finance everything. Well, why is that bad? Why is that a problem? Well, it means you either borrow money and pay interest to commercial banks, which is where we're currently choosing to store our wealth, just like every American, or we use our money and give up interest that we could have earned, meaning we save up the cash and we buy that whatever it is in cash. And we're told that's the better route. Well, guess what? You just lost the ability to earn interest on that money you just spent ever again your entire life. An interest cost doesn't last 1 year, it doesn't last 2 years, it lasts forever. You lost the ability to compound on that money forever. So put that math, that compound interest on the money you spent on every single purchase you make, every financial decision you make. Think about how substantial that money is that you're missing out on by just spending it, whether it's cash or financing it, either way. We've been taught to get into the business of investing, but really, who's in control of that world? The banking organizations, Wall Street. When we pay cash or we finance it, they're at the core of it. They're collecting, they're controlling, they're making insane profits actually off all the hard work we're doing. And this is why we should desire to become our own bank. So we can be in control in the center of all these transactions. We can be the one earning interest always. So how does a bank actually work? Well, here's a real life example. I'm sure many of you actually have seen something like this before, but this really speaks to the volume of what this is. Let's say you have 100 grand. Say you have 100 grand, you dump 100 grand into your bank account, you're stoked, your bank pays you 4%, and you're like, oh, found the best bank in the world, I'm going to crush it here. Awesome. Well, now what does the bank do? Obviously, that money sitting there, it's actually a liability to them. They need to lend it out. And so they do. They'll give it to someone down the street who's going to buy a house at 7%. And then what are the sellers going to do when they get paid? Put it back in the bank. Well, what's the bank going to do with the money again? Well, lend it somewhere else. He'll lend it to somebody looking to buy a car at 8%. Who's going to then pay the car dealership? Who's going to then put the money where? Who will then lend the money out again on a home remodel loan at 9%? And these rates are just examples, guys. At 9%, who's going to pay the contractor to do the rehabs? Who's going to put the money back where? And let's say the contractor then goes and blows it all on red in Vegas. They go into debt and they got to pay off their credit cards. They get a debt consolidation loan at 12%, pay off the cards. And where does the credit card companies put the money back afterwards? Right? Who's in control of all these transactions? Not you, the bank. While you're making four, they're making seven. They're making a 3% spread. While you're making four, they're making eight. They're making a 4% spread. While you're making four, they're making nine. They're making 12. Okay. If you total all of those up, they're making 3% more than you on the home, four on the car, five and eight. That's a total of 20% more on your 4% that they're making. And I say that in a very specific order because some people would say, oh, you're making four, they're making 20, they're making 16% more than you. No, if they're making 20% more on your money while it's there, they're not making 16% more. They're making, because what, four goes into 25 times. They're making 500% on the money you leave there. Okay? If you look this up, BauerFinancial.com, you will find that banks make between 400 and 1,300% on the money you leave there. You can actually get any bank's annual report from any year, and you can see this. That's why when you go to any downtown spot, any main street of any city in the country, who owns all the downtown corner lots? The banks. Guys, we are paying them to do that. So earlier when I told you guys that these banks are the number one purchasers of these specially designed whole life policies, the thing I said was, are the banks stupid? Or do they know something that we don't know? You now should know they're not stupid, guys. So I've thus far, the past 15 minutes, just laid the framework of what banks do and why you would want to become the bank and the power of actually what a whole life insurance is and the credibility behind it. So let's now go into the action side of this. Let's go into the numbers. Let's show you guys real examples of how you can actually use whole life to be the bank. And I like to start with a very simple example of buying a car. Everyone buys a car. Everyone knows what buying a car is like. Very easy. I'm going to show you guys how to buy a car and get back every single dollar you put into that car. Any car you ever buy, drive, or own the rest of your life, this can work for. And this is a sweet truck I just found a photo of online. I wish it was my car, but it's not. So just an example. But I'm going to show you guys a couple things here to start. Let's show you what a policy looks like and how you'd use it. Now, don't dive deep into these numbers on the right side here. It's just there for an example. I'm going to dive deep into the numbers in like 2 minutes. So hold off those numbers real quick. I want to talk about the machine, the policy we use. Let's take a look under under the hood, what's actually happening with this vehicle. And let's start with premiums. When you hear the word premium, you think of your life insurance, your health insurance, your car insurance, and you think, ah, it's a bill, it's a payment, it sucks. Well, remember what this whole life insurance is. It has liquidity. And who doesn't want to? And if you store money in a bank account because it's liquid, I've never seen somebody who wants to deposit and store less in their bank account, right? So if this policy is structured where it's equal, you have liquidity, then who cares? Why wouldn't you want to deposit every single dollar you can into something that's liquid and better than keeping money in a bank? So don't look at these premiums as a payment. We need to change our mindset when we look at this because it's not a payment. It's really not. It's not an expense. It's a deposit. It's liquid. It's available. It's growing. And so I changed on here. I wrote on the right side, you see under deposits, I wrote deposit, not a payment or a premium. And second, people say, I'm too old to get life insurance. Well, you're not. If I told the insurance company we want to deposit 10 grand a year into this thing, and if you are 50 or 20, the only difference is going to be the 20-year-old has a bigger death benefit than the 50-year-old. But we're telling the insurance company how much premium we want to put in. We're telling them how we want the cash value structured. So age does not matter. Obviously, you have to get approved for life insurance. I mean, this is life insurance you're getting. So if you're unhealthy, you're overweight, things like that could cause issues. But age in general does not matter. And the death benefit. I know we're not going to hit the death benefit at all really today. It's just really a cherry on top. The fact that you can store money somewhere and have all those benefits, and on top of that, have a death benefit too in case something happened, that's pretty freaking awesome. And so I'm not going to talk a lot about it, but just understand there is a death benefit. So let's go into a real life example. How do we use this policy to buy a car? Well, I'm going to show you paying 10 grand a year into this policy for 7 years. And then the cash value on the right side. That is the liquidity. That is how much access to your capital you have within your policy. And so the insurance company, after you pay 10 grand into it, they say, hey, you have access to 5,800 bucks in year one. Okay, cool. Year two, you have access to 12,000. Year three, it drops to four because I'm going to say, let's take $25,000 out of the cash value and go buy a car. So that's what we do. We take 25 out and we go buy a car. Just to sum this up real quick, all your premium deposits that you pay into this policy are going to sit with the insurance company. They're going to grow tax-free, compound with interest, protected from lawsuits, creditors, the markets, the banks going bankrupt. It has a death benefit. Your premium dollars are extremely safe and growing. And then the insurance company says, while your money's sitting here doing those things, we'll let you take a loan against it. That's called your cash value. That's what you have access to take a loan against. And so while you take a loan from your cash value, your premium dollars still sit there and grow. So in year three, when he takes 25 out of the cash value to go buy a car, his 30K of premiums he's paid thus far in 3 years are still in the policy, still growing, still taxed free. So now when he takes a 25K loan from himself, his own bank to buy the car, we're going to pay ourselves back. If we're going to take a loan from ourselves, from our own bank, wouldn't we pay our bank back with principal and interest? We said that in the very, very beginning. We would. We wouldn't steal from our own business. So that's what we're going to do again here. We'll take 25 out, go buy a car, and we're going to pay ourselves back $500 a month for 60 months. Because if I went to the local bank and got a 25K loan, that's what the terms and payments would be. So I'm just going to treat myself the exact same way I would treat anyone else. So now look at that. Over 7 years, you've paid 70K as premiums. You've paid 30K to repay your loans. So you've really put in 100 grand into this policy. That's a lot of money over 7 years. And you took out 25 to go buy a car. Okay. So your net injection is 75K. Over 7 years, you put in 75 essentially. But look at your cash value at the end of 7 years. It is 67 grand. You have access to 91 cents on the dollar. You put in 75, you have access to 91% of it, 67. And you have a car fully paid for. You could also say you got back 91 cents on the car you just bought. Okay, think about that. Look at these numbers, try and dissect it a little bit further. And I'm going to show you another example in a second that I think will maybe just re-emphasize what we're doing. So let's take a look. Let's say in the next few years, he wants to keep doing this. But after 7 years, he can't pay any more premiums. He doesn't want to. Fine. So he stops paying premiums. There's no premium deposits. And he wants to buy another car, this time for his wife. So he takes 25K from the cash value, a loan from his bank, his policy, and buys a car. He then pays himself back 500 bucks a month, just as he would pay anybody else. Over that new 5 year period, he pays zero in premiums, 30K in repayments. And so he also bought a car for 25. So really his net injection into this is 5 grand. He puts in 5 into the policy. But again, look at his cash value. It went from 67 to 91 over that 5 year period. It grew by 23 grand and you put in 5. He just put 5 in and got 23 back and bought a car. You could now say he got that car for free and he made money on that car. Okay. Now look along over the whole 12 year period, what happened? He put in 75K in the first few years. He put in 5 grand in the last few years. He put in 80K into this policy in total. And his cash value at the end is 91. He has access to 91. He puts in 80. He made 11 grand off of buying 2 cars. So yes, indeed. I told you I'd show you how to get all the money back for any car you ever bought, drove, and owned. Here it is. This is how. Now, there's 3 rules I use when I do this. Rule number 1, pay yourself first. He was saving 10 grand a year already. He just chose to redirect that into his bank instead of the commercial banks and someone else. He then chose to take a loan from himself and pay himself back with interest as he would treat anybody else's bank, anybody else's business. He then recycled and recaptured the interest because he paid back 30K instead of 25 that he really took out. He paid himself back extra, repaying himself and recycling the interest to himself he would have otherwise paid to somebody else. So rule pay yourself first. Rule two, pay yourself with interest. Rule three, recycle and recapture the interest you are paying. And if this works for a car, what else does it work for? Well, guys, that's when it gets fun. There's no cars to buy. There's no things we need to purchase. It only gets better from there. I'll give you one more example and kind of show you a different diagram to maybe help cement this idea. What if you had debt? Okay. What if I had 30 grand sitting in my current bank account and I have a $23,000 line of credit and I don't want to pay it off because, whatever reasons. Well, in this scenario, let's say I do. Let's say I put 30K in my policy. I then take 23 out and I go pay off my line of credit. That 23K, I take a loan from my policy. It comes to my bank account. I then pay off the line of credit directly. There you go. 23K line of credit's gone. I was paying 9% on that note. My payment was about $300 a month. So what am I going to do now with that $300 a month payment I no longer have to make on that line of credit? Well, you have to pay yourself back somehow if you're taking a loan from yourself. Why don't you just pay yourself back the same way you were paying somebody else? You were paying them 9%, $300 a month. Do the same thing. So now recycle and recapture that money. Pay yourself back $300 a month. So look, the money's flowing in this circle. It's just circulating through a place that you control. Okay? And remember what's happening with your 30K you deposited into the policy from the jump. That's still sitting in the policy, earning interest, tax-free, protected, giving you a death benefit. While you now take a loan, pay yourself back, and just recycle and redirect who you're paying this money to. And how many times are you making money in this transaction? I just told you, two. Your 30K is sitting there growing. You're making a spread inside the policy. And you're paying yourself back 9%, 289 that you were paying somebody else. You're making money two times in this whole transaction. Now, what if it wasn't debt? What if it was an investment? PMC, Private Money Club, is a place I sometimes lend my money. Let's say you do that. Let's say you take money out of your policy, you lend it to somebody there, they're paying you 12% on a note, you get monthly payments from that interest. Where do you put the income from the investment? You recycle it and deposit it right back in the policy, keep the money flowing. And now look, with an investment, it only gets better because now it's not a payment you get to free up, it's new income. So at the end, when your note's refilled, you have excess income, excess money. Now go make more investments and accelerate building wealth. This is the stage I'm in. I got no debt. I don't have any purchases I need to make. I don't need to buy a car. I'm in real estate. I'm buying rental properties every single chance I get, and I'm buying all of them through my policies. My money starts over here on the left with my policy, goes through my bank, goes and buys, puts down payments on rental properties. Then with the cash flow from the rentals, I just repeat and refill my policy, and then when that gets to enough, I go buy another one. I just run all my money. I cycle all of it through a policy instead of a traditional bank. So, guys, I'm not changing what you invest in. I'm not changing your expenses. I'm not changing what you have to buy as a family. I'm just changing how you buy it, where your money resides while you do that financing activity. I hope that makes sense. So, real quick, just to finish up here, only one of two things are going to happen to us throughout our lifetime. One, we're going to live. We all know that. We're all alive. We're crushing it in our lives, right? We're happy. Are we better off with or without this throughout our life? Well, I just showed you how to pay off debt in a more efficient manner, showed you how to buy a car in a more efficient manner, make money off buying a car. I just showed you how to make more money on your investments. So heck yeah, you're better off with this than without it. And what about your family? When you pass away, we're all going to pass away. Well, guess what? There is a death benefit. So your family is going to be way better off with this than without it. Now they're going to get some sort of multiple of what you put in when you pass away, compared to them getting nothing or whatever's just sitting in your bank account when you pass away. And that has to go through probate and all that stuff. You are better off with this than without while you're alive, and so is your family when you die. So you're not just setting yourself up, you're setting up the next generation to build wealth quicker than you did. That's why the whole concept's about building generational wealth. That's how the Rockefellers have done it, and that's why banks get wealthier and wealthier every year. So I end here with just saying I'm grateful for you guys. If you sat through the last 30 minutes, you are one of few. Not many people want to level up in their money tactics, their money game. Most people don't even know how. Most people won't sit through 30 minutes to learn something. They just want to scroll on their phones. You guys are awesome for being here. I know this strategy is really important to this team, to me, and it's created a lot of success and stability in people's financial wealth building. So I have just my email here. If you guys have questions, I mean, this is 30 minutes. This is a concept that took me years to learn. If you guys want more resources, just email me. I'll send you books, podcasts, videos, examples, more numbers, anything you want, I'll send you. If you want to have a one-on-one consultation where you just learn how this can be implemented into your life, I work everything off of for free. I will not charge you to meet with you. I'll not charge you to set up these policies. I can build this system out for you as I have with many others for free, and that's because I get paid from the insurance companies. I get paid for the business that I'm bringing them. So it's a cool little business model where I don't charge you anything. I'm just a really a third party service to help you do all this the correct way. And then you go off on your way. You become your own bank. You build your family banking system yourself. I'm here to just make sure you do it right. So if you do want to have a consultation and just talk about it with me, that is my email. You can email me just your name, your info, and let's talk. If you want more resources, let me know as well. I thank you guys for being here. Thank you for your time and energy. Have a good rest of your week.